Why do the rich seem to get richer, while the rest of us are told to fear debt like the plague? What if I told you that the very thing we are taught to avoid is one of the most powerful tools the wealthy use to build their fortunes? I told you that the very thing we are taught to avoid is one of the most powerful tools the wealthy use to build their fortunes. It sounds crazy, right? We're all raised on the idea that debt is bad. Live within your means, they say. Cut up your credit cards. But for the world's most successful people, debt isn't a four-letter word. It's a secret weapon. Today, we're pulling back the curtain on how the 1% really thinks about debt, and it's going to change the way you see money forever. Let us start with a simple idea that forms the foundation of this entire concept. There are two types of debt. There's bad debt, and there's good debt. Most of us are only familiar with bad debt. This is the kind of debt that makes you poorer. Think about high-interest credit card debt used to buy things that lose value, like designer clothes, expensive dinners, or the latest smartphone. You swipe your card, get a temporary high from the purchase, but then you're stuck paying it off for months, or even years, with interest piling up. The item you bought is worth less and less over time, while the debt you owe grows larger and larger. This is a wealth-destroying cycle. Car loans for depreciating vehicles and personal loans for vacations fall into this category too. They're liabilities. They take money out of your pocket every single month without putting anything back in. This is the debt that the poor and middle class are often trapped by, and it's rightfully feared. It's a heavy anchor that drags you down financially. Now, let's talk about the other side of the coin. Good debt. This is the kind of debt that the rich actively seek out. Good debt is used to acquire assets that generate income or increase in value over time. Instead of taking money out of your pocket, good debt puts money into your pocket. Let me give you a classic example. Real estate. A wealthy investor might take out a loan, which is debt, to buy an apartment building. They use the rent collected from tenants to cover the mortgage payment, property taxes, insurance, and maintenance costs. If they've done their math correctly, there will be money left over at the end of every month. That leftover money is called cash flow, and it goes directly into their pocket. So, the debt is actually paying for itself and generating a profit. Not only that, but over time, the property itself is likely to appreciate in value, and the tenants are slowly paying down the loan balance. The investor's net worth is increasing from multiple angles, all funded by the bank's money. They used other people's money, or OPM, to buy an income-producing asset. This is the fundamental difference in mindset. The poor use debt to buy liabilities that make them poorer. The rich use debt to buy assets that make them richer. Let's dig deeper into this concept of leverage. Leverage is simply using borrowed capital to increase the potential return of an investment. Imagine you have $50,000 in cash. You could use that to buy $50,000 worth of stocks. If the stock market goes up by 10%, you've made $5,000. Not bad. But a wealthy individual might see that $50,000 differently. They might use it as a 20% down payment on a $250,000 rental property. Now, let's say the real estate market in that area also goes up by 10%. The property is now worth $275,000. That's a $25,000 gain in equity. You used the same $50,000, but by leveraging the bank's money, you controlled a much larger asset and amplified your return fivefold. Your return on investment isn't 10%. It's 50% on your initial $50,000. This is the power of leverage, and it's why the rich love debt. It allows them to multiply their money at a speed that's impossible with cash alone. Of course, this comes with risk. If the property value goes down, your losses are also amplified. This is why financial education is so critical. The rich don't just blindly take on debt. They spend an enormous amount of time and energy learning how to analyze deals, understand markets, and manage risk. They know their numbers inside and out before they ever sign on the dotted line. They have contingency plans for vacancies or unexpected repairs. The fear of debt in the average person often comes from a lack of this financial education. When you don't understand how to make debt work for you, it's natural to only see the downside. Another major reason the wealthy favor debt is because of taxes. This is a huge, often overlooked advantage. In many countries, the interest paid on investment loans is tax deductible. Let's go back to our real estate example. The interest paid on that mortgage for the apartment building can be deducted from the rental income, which lowers the investor's taxable income. This means they get to keep more of the money the property generates. On the other hand, the interest you pay on your credit card for that fancy dinner, that's not tax deductible. The interest on your car loan for a vehicle that's just for personal use, also not deductible. So, not only is bad debt making you poorer by its very nature, but the government also offers you no tax relief for it. Good debt, however, not only puts cash in your pocket, but also gives you a tax break. It's like getting a double win. Wealthy individuals and corporations are masters at using the tax code to their advantage, and debt is one of their primary tools for doing so. Furthermore, let's talk about inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. We all feel it when the price of groceries or gas goes up. Your cash in the bank is worth less and less each year because of inflation. If inflation is at 3%, your $100 in a savings account will only have the purchasing power of $97 next year. But for someone with a large fixed-rate loan, inflation is actually their friend. Imagine you took out a $300,000 mortgage 10 years ago with a fixed interest rate. That $300,000 was a lot of money back then. But today, due to inflation, $300,000 is worth less. The payments you make each month are made with cheaper dollars than the ones you originally borrowed. Meanwhile, the asset you bought with that loan, like a house, has likely increased in value, partly due to that same inflation. You borrowed expensive money and are paying it back with cheaper money, while the asset you control becomes more valuable. You are effectively getting a discount on your debt, courtesy of inflation. The rich understand this dynamic perfectly. They lock in long-term, fixed-rate debt on appreciating assets, knowing that inflation will erode the real value of that debt over time. So why isn't everyone doing this? Why are we all so afraid? It comes down to mindset, education, and the system we're raised in. The financial system is largely designed to benefit the lenders, not the borrowers. Credit card companies, payday lenders, and personal loan companies thrive on people taking on bad debt with high, often variable, interest rates. Their marketing is everywhere, encouraging us to buy now and pay later for consumer goods. We're sold a lifestyle, not a strategy for wealth. The education system rarely, if ever, teaches us about good debt versus bad debt, leverage, or cash flow. We learn algebra and history, but not how to read a balance sheet or analyze an investment property. This creates a population that is financially illiterate and therefore easy to prey upon with high interest, wealth-destroying products. The fear of debt is a manufactured fear, cultivated to keep the majority playing a game they can't win, while the few who understand the rules use that same debt to build empires. Breaking free from this mindset requires a radical shift in thinking. It starts with education. Instead of just working for money, you start to learn how to make money work for you. Read books like Rich Dad Poor Dad by Robert Kiyosaki, which is a classic on this very topic. Follow financial educators online. Listen to podcasts and learn the language of money, assets, liabilities, cash flow, return on investment. Start small. You don't have to go out and buy an apartment building tomorrow. Maybe it starts with using a low-interest loan to take a course that increases your earning potential. That's a form of good debt and investment in yourself. Perhaps it's learning about how to invest in dividend-paying stocks or real estate investment trusts, REITs, which allow you to invest in real estate without buying physical property. The key is to change your perspective from that of a consumer to that of an investor. A consumer asks, how much does it cost? An investor asks, what's my return? The wealthy view debt as a tool, no different from a hammer or a computer. In the hands of a skilled craftsman, a hammer can build a beautiful house. In the hands of someone who doesn't know how to use it, it can cause a lot of damage. Debt is the same. It is a powerful force that can be used for creation or destruction. The fear that keeps most people away from it is precisely what prevents them from accessing one of the most effective wealth-building accelerators available. By understanding the difference between good debt and bad debt, learning the principles of leverage, and prioritizing financial education, you can start to think like the wealthy and maybe, just maybe, start using their playbook for your own financial success. It's not about getting rid of all debt. It's about getting rid of bad debt and strategically embracing good debt. That is the secret. Thank you for watching. If this video shifted your perspective on money, make sure to like and subscribe for more content that challenges conventional financial wisdom. Let us know in the comments what you think about good debt versus bad debt. See you next time.